Well, you have 90 minutes and we'll probably interrupt at any time.
Please, of course, please do.
Mhm.
All right, so thank you very much for the invite this week. I'm having a great time. I've been in South America since over 2 weeks now, so it's lovely here. I really enjoyed my time. So this paper, as was said, is it's about credit cards and in particular about the credit limits on our credit cards. This paper is not yet publication stage, so any comments will make the paper better. So I really appreciate any interruptions, clarifications, anything. I'm looking at this because there's only one thing I have to say in this talk, which is to say the usual disclaimer, which I'm sure you're familiar with at your institution. I'm using data from the English financial regulator, the Financial Conduct Authority, and all the views are my own and don't necessarily represent their position. Very good. So let me start by summarizing what I'm going to say. This is a bit like the abstract of a paper. So what am I going to talk about today? So in this paper, I have access to a new data set on around 80 to 85% of all credit cards in the United Kingdom between 2010 and 2015. And what I start in this paper by doing is documenting some facts about credit limits and interest rates in the UK credit card market. And much of what I'm going to say today, from what I've learned in the last 5-6 years of working on this paper, also apply to many credit markets in Europe as well. And I'll explain why. And the first thing that I'm going to show and talk about is how when we're thinking about individuals' credit cards, there is only one variable in the data. It shows that there's only one variable that lenders tailor and discriminate and individualize based on how risky a customer is, and that's the size of their credit limit, the maximum they can borrow on the card. And the key word here is only, because what this means is they do discriminate the credit limits, so the credit limits are risk-based, but every other variable you can think about is not tailored according to customers' risk. And in particular, that means price is not tailored to customers' risk. So you can have a person who has a very high default probability, and they'll get the same interest rate as someone who has basically no probability of default in the UK credit card market. And this is kind of at odds with what is traditionally been talked about in these markets, with risk-based pricing being the big concern and lots about price discrimination, as I'll discuss on the next slide. And I'm going to say this 3 times in the talk because it's very important to understand that this is in line and is linked to some regulation we have in the UK credit card market. And the regulation requires 2 things. First, on any credit card product that a lender wants to market and sell, they have to advertise and promote one interest rate, which is called the advertised interest rate, or APR. So they have to show one number, so like 19% is a very common number to have in mind here in the market. So they have to have that as shown in all the promotional materials, in all the marketing. They have to tell the customer that number is the representative interest rate. And there's a limit or a minimum amount of people that have to get that rate on their version of the card. So they advertise 19%, and nowadays at least 50% of the customers, when they get their version of the credit card, have to have that interest rate of 19% or lower. So this regulation, though, only means you have to give the same interest rate to half of your customers. But what we see in the data is that essentially everyone gets the advertised interest rate. So they don't play around with the interest rate at all on a given credit card product. And this is I know this is in contrast to the US credit markets, where there's well-documented evidence of price dispersion on given credit products across customers' risk. And from my limited understanding from reading some papers in Chilean credit markets, maybe not the credit card market, I'm here to chat and find out these things, but definitely in some Chilean credit markets, I know there is some risk-based pricing going on. So I put a question mark here because I'm not entirely sure, and that's what I'm learning. But US for sure. The UK case is very different to the US case. And this regulation I mentioned is actually European. So any credit product in the whole of Europe has to advertise an interest rate. And that has to be given to at least half of the customers who get that product. So this is the first part of the paper where I'm laying out the landscape in some respects. This is all descriptive, so I'm just looking in the data. I'm not making assumptions, just seeing what's there. And what I want to do with the second half of the paper is to study, well, what are the consequences of this difference between the US and the UK? How does it affect consumers? How does it affect lenders? What is going on underneath this? And in particular, kind of broader academic question is, well, how do lenders in general want to individualize interest rates and maybe credit limits? Like, is there only need for one of these tools? Can they benefit from using both of the tools? And why might they individualize a customer's interest rate and credit limit, potentially if they weren't regulated? So what I do once I build a model of the credit card market where lenders set credit limits and interest rates for customers, and individuals choose credit cards, borrowing and default. I'll talk through this obviously slowly as we go along. So I estimate this model, and once I have the model, I can strip away all of the regulation to mimic an environment more like the US case. And then we can see, well, which consumers does it affect, and what would lenders do if they had no costs or regulation on individualizing interest rates? Would they start using these tools? What do they gain potentially from using individualized interest rates and credit limits, and whom does it benefit and harm? And what I find in that case is that lenders can increase their profits quite substantially if they weren't subject to this regulation. And the glue that holds the whole argument together is that they must have been facing some costs, some shadow costs of individualizing customers' rates, because otherwise it might be a bit confusing to you that there's a regulation that is not binding that actually seems to have an effect on them when I take it away in the counterfactual. And what's happening here is that the story that is told to me when I speak to industry experts is that, if you have to advertise an interest rate, customers are expecting to get that interest rate. And if you suddenly start giving customers a different rate once they get the credit card, that may lead to some reputational damage and some customers complaining and so on and so forth. And let me give you an example of what I mean here outside of credit markets. If you went into a clothing store or a shoe shop and you bought a pair of shoes for $100, you saw a price tag for $100, a pair of shoes, you go, okay, I'll buy them, $100. And you take them off the shelf and you go home, and then you look on your statement for your debit card and it says $200. You would think this was like illegal, right? You would be very mad. You wouldn't think it's acceptable that you could see a price tag that says 100 and yet you've ended up paying 200. And I think it's the same story here in the credit card case. If you are looking at which credit card to get and you see 20% interest rate, and suddenly once you get the card a couple of weeks later, they tell you, sorry, actually your interest rate is 30%. Then customers are quickly not going to be very happy about this arrangement. So these are the kind of reputational costs that lenders face when they have to advertise an interest rate, as they have to in the UK case. And so that's the story. Yes.
Just to get a sense of the size of this market, do you know how it compares to the market for household loans from banks?
I mean, this is by far the biggest unsecured credit product in England. About 70% of transactions happen on debit cards, so I guess that's similar to here. But this is much bigger than just basic loans. Yeah, this is most unsecured borrowings.
Okay, a quick follow-up. There, I guess they don't charge interest if they pay in the following month.
That's right.
Do you know what fraction of that debt is actually charged interest?
So about 50% of statements pay the balance in full, and about 25% of customers always pay the balance in full in 2 years. So in the model, I won't talk about it today. I take care of the fact that there's different kinds of customers, some who never create interest and some who do. This is going to actually be quite important as we go along. So I will come back to it.
So just to understand the data, do they have like interest rate caps, like maximum interest rate?
Not here, no.
UK, no.
No. Just to quickly tell you, there was a product called Payday Loan, which is a very short-term credit product that was capped, but this is nowhere near binding for credit cards. So it's like 208% APR. So.
How likely is that, this bank rejected an application for a credit card?
Good question. I'm getting new credit card data potentially soon where we would have applications, and I can answer that question a lot better. What I have with this data is one lender did give applications, and about 80% of applications were turned into a a credit card at that lender. So I'm not hugely worried about this point, but it is a very interesting thing where hopefully there's a follow-up paper soon actually on exactly this question about rejection. So I'm interested in that.
Thanks.
Any other? Yeah.
The credit market and the limits you explore, it has any differentiation between currency, for instance, euro, pounds, or they don't have any difference in limits?
You mean like foreign transactions?
Yeah.
No, I guess it's all turned into one currency, and you'll pay a fee if you on most cards if you use it abroad in this period, but it all goes into the same pot for the limit. Yeah. Good. All right. So this is now I've told you everything I'm going to tell you about, and now let me make sure it's clear why we might be interested in this. So there is a long literature in economics and finance, mostly theoretical, about credit rationing. There's this like Stiglitz and Weiss was not the first paper to do it, but it was a seminal paper really, and in explaining why in these markets with adverse selection, you may have a case where the interest rate means that some individuals cannot access credit, and that credit is rationed. That's the story, and so I guess, as you can see, I'm talking about credit limits, and the story these days, as I'm telling in the paper, is that in the UK, about 80% of adults have a credit card, maybe slightly lower. So pretty much most people can have a credit card if they want one. The way that credit is potentially rationed, and what I want to study is on the intensive margin. So it's not about whether you can get a card or not. It's about whether the amount of money they give you on the card is what you want. And we're going to find that many people I'm going to show are rationed on the intensive margin. They would like to potentially use more of their, they would like to have a bigger credit limit, and their lender caps them. So there's this, it's this paper, my paper is about this intensive margin of how much credit you have on your card. And despite this theoretical interest, most of the discussion that we see in policy discourse and empirical research recently has looked at the price aspects, at the interest rate. And there's been a lot of discussion, especially very recently, concern about whether lenders are using these kind of machine learning advanced algorithms to tailor their contracts very finely based on what they know about customers. And so that's been discussed a lot. And indeed, let me say for the second time, so it's clear, the regulation in credit markets has been on trying to limit the extent of price discrimination. And so the lenders have to, as I said, advertise one price, and that has to be, it has to be representative in the sense that a majority of customers must be obtaining what you're advertising. So this is all credit markets in Europe. So that's where the regulation has come. And also in the US, there's a very recent and important credit card paper in the US by Scott Nelson, looking at how in US regulation stops lenders from tailoring customers' interest rates after they've got the card. So over time, the lenders aren't allowed so much now to start increasing or decreasing customers' interest rates based on their behavior. The Card Act, which is a big US credit card act, recently stopped lenders from doing that. My paper is, and this regulation is all about how you set the interest rates at the moment the customer gets the card. So you can see there's in EU and US, there's been regulation looking at price discrimination. And this is not just, I know here we're mostly interested in finance, but this is also in just insurance as well. The Affordable Care Act on health insurance limited the extent to which lenders could differentiate premia based on individuals' characteristics. And so you can see that most of the discussion is on the price, and there's nothing really on discrimination on, the coverage of insurance or the amount of credit. And there's, these open questions, should we be thinking about, how these credit limits are set? And so I want to do in this paper is both empirically and in the model, provide us a model of how to think about lenders setting quantities, setting quantity limits, and study in the data the use of quantity discrimination alongside potential for price discrimination. Yes, Enzo.
One question. What kind of competitive setup do you have for credit? Because what I'm thinking is, the story of credit rationing in Stiglitz and Weiss really works at the debtor level, so the borrower level. You are capping in total how much you can borrow. But when you have individual credit cards, you could have multiple credit cards, and each lender is only setting the limit for one.
Yeah.
So that's, and in that sense, is different from pricing, which you could manage risk. If you are a monopoly, you could manage risk both ways. But here, you really.
Two things to say. The first is to defend myself to get out of this trouble first. I say, and I'll talk about it more later, most individuals in the UK have one card. And I'm saved on that because obviously in the US, they have a billion per person. So that's a severe problem in the US context. So that helps me. The other thing, though, is more constructive an answer, actually, is to say that I think this is a super interesting question because if you're a lender, you don't internalize the fact that the credit limit you're giving someone has an effect on the fact that someone else is lending to them as well, and that you give them money, it might increase their probability of default for someone else, and so socially we might be over providing in that case. And another interesting case and topic, and you talked about competition, is if I'm in a lender, and actually most of the competition in this market is to get people to switch to you. You don't necessarily want people who don't have a credit history. You don't want these new people. You want to get someone who's got a track record of borrowing with someone else and steal them. And so to preempt that as a lender, you want to give someone as much credit as they need so that they don't have incentives to go to someone else. And both of these things I've said are open questions and open for research, I think. I haven't done them yet. I'm interested in them. So they're good questions.
Just to clarify,
yes,
the 50% of customers are new customers or the existing customers? Or...
Yeah, so this is all when new customers, when you sign up to get the card. Yeah.
So it is, but then I didn't understand. They can change the...
They can and they don't. So I'll talk about that. I will talk about that.
So I still don't get the shoe example, right? Because it's not that you go back to your house and see that they charge you more. You see the advertise. I think then you go to the bank and they can explain you that that's just a mean rate and they can change it.
Yeah,
and it's legally.
But it is legally allowed, and you can't take them to court over it. But it would probably annoy you. The thing that's relevant,
but it would be annoying for the guys that are very risky. So at the end, the bank shouldn't
worry,
right? Because they're the risky guys that they will go and they get.
But the point is that the key point is that you don't need to. You can control default risk with the amount of credit you give them. And
no, I see that. Yeah. I don't see how this law at the end impose a very high cost, as you said.
It's not so much the buy, the 50%. It's really the salience of the advertised rate. Yeah. And
that I don't see.
Well, I mean, the model is saying it's very hard to square the fact that they can get profits from individualizing interest rates and they don't do it. So that it's almost mechanical that there must be some underlying cost. I mean, yeah, I'll talk about maybe what that is, and I'm not compelled by my answer. That's fine. I mean, it's an open question what it is. I did want to say though, the institutional setting is important, and I'll talk about that later because you can't find out your rate, the actual rate you're going to get until you've chosen the card. And that's why the government is so keen for there to be a rate that's actually representative. Because otherwise, how can customers shop around as well? I mean, if you don't know what you're going to get. So, okay. Right. So just let me do the research questions. I've said most of this already, but just to repeat. So first, I just want to understand in the data, how do lenders in the UK individualize contracts? This is mostly coming through individualizing the credit limit, and in particular, around 90% of customers, interest rate that they receive is exactly the one that's advertised. The 10% is mostly coming from subprime lenders who have a slightly different business model. That's in an appendix of my paper if you're interested, but I won't go into that today. And then, as I said, the counterfactual exercise is if I take away the regulation and the cost of individualizing interest rates, akin to, I guess, what is going on in the US, we see the model finds that lenders do start individualizing interest rates substantially. And this is like a price discrimination story, exactly like the learner story, where the inelastic customers are the ones who receive higher rates. And it's actually not per se the risk. It's about the elasticity of customers that you would tailor the interest rate on, whereas the credit limit is tailored to cover your downside risk in the case of default. I'll say this again on the next slide, but exactly. So what I find is quite substantial profit increases based on the model in this world. And the consumers that are harmed is the ones that have inelastic demand, which are the ones, as we know, that you would want to set a higher price for. And the key thing to understand is that, and a key parameter in my model shows that there's a correlation between how risky you are and your elasticity of demand. So I'm going to estimate both. I'm going to estimate elasticity of demand by how risky you are. And the parameter I estimate says that it's, the more risky you are, the more inelastic is your demand. And so when we see what we think of as risk-based pricing, because we see customers with high FICO scores getting low interest rates in the US, for example, then the question is that really because they have high probability to default, or is it because we know they have inelastic demand for credit? And my model suggests it's the latter. And that really what's going on is this correlation between risk and elasticity is driving the risk-based pricing.
Can I ask you a question?
Yeah.
Sorry. So what happens with consumer surplus for those who have more elastic demand?
It does increase slightly, but it's not symmetric in the end. It doesn't have to be in the model, and it's really not.
There's some that gain, there's some.
Absolutely, yeah. There's distributional. This is distributional effects. On net, it's pretty small, the average, but that masks all of the heterogeneity.
Yeah.
So.
What happens with credit rationing when you allow for this interest rates?
So credit limits rise in the counterfactual, which can happen and does happen here. On the extensive margin, if that's what you're asking about, whether people well, yeah, and so I can do the intensive margin because I have a model of credit limits. One of the disadvantages of the data, I don't have any data on individuals without a credit card, so I can't assess that margin. That margin is obviously quite important here, right? I mean, what might happen is people might be opened up to the credit card market if lenders can tailor both tools, and I can't capture that. So,
right. I'm just a little bit surprised that, I mean, which is the idea that even if you can set up this credit limits but not interest rate, then you can still avoid credit rationing. I mean, but basically that's what you're saying. At least
on the extensive.
Market, yeah.
There's going to be a lot of rationing on the intensive margin, as I guess I'll talk about quite quickly.
Okay.
Yeah, so the takeaways is that it's about this, what is this regulation doing then? It's protecting, or that's perhaps a strong word, but it favors the customers with the inelastic demand. But they're the ones who happen to be the most risky. I will explain that in more detail later. And so this risk-based pricing is nothing more than what we know of as old school price discrimination. And so these tools are in some respects complementary. There is an incentive to use both as a credit card lender. And when the industry experts I've spoken to, they talk actually a lot about administrative costs. There's always going to be setup costs to tailoring your interest rates, but economists don't really like that explanation so much. And the explanation that they talk about often is reputation risk. You have to remember this is just after the financial crisis. Lenders are worried about their reputation, and it would be harmful for there to be a national newspaper article saying, by the way, these lenders are, advertising on interest rate and giving customers something else. Okay, good. So let's go on.
Yeah, before understand your answer to the past. So in the shoe example, so you're saying then that there is another guy who sells shoes just next to the store, right? And that's the thing. It's not that you come back and you get annoyed. You go inside the shoe, ask the price, and they say no, it's a different one. I mean, the other guy has the shoe just there at 100. So this regulation, what it's doing is just to make the market more transparent in some sense.
Yes.
Okay.
Yeah.
It's not that. Yeah.
Good. Yeah. And this is actually, I guess, the underlying trade-off here. That's what the government talk about a lot. I mean, the government is looking for transparency, but on the other side of the coin, we are worried potentially that if you limit the ability to price discriminate, the market might unravel. And that's the tension. And I guess part of the story I want to add to that debate, but that's what the debate is that, well, they can also tailor the credit limit. So we're not necessarily tying up their hands so much. Good.
So do you have some results on total welfare? Because I think you mentioned bank profits. I don't think it's surprising that the banks increase profits, but
Yeah, so the profit increase is larger than the net consumer surplus. So, the regulation on welfare funds, right?
So the source of what you expect with price discrimination is, I mean, there is no increase in quantity, which you are not allowing in your bonds.
Yeah, but going there, I'm a little bit hesitant to talk about welfare too much, and this, it's difficult, especially because my demand estimation is quite reduced form in some respects. This is not like a underlying utility, and so I'm a bit nervous about going.
Okay, but the distributive effects, what you expect, like the firm is earning more, the more inelastic are losing because of price invention, and the low elastic.
I think the distributional effects are more interesting than the net, personally. Good.
And last question.
Yeah.
You're using like new customer? Because I was thinking that, I mean, over time, maybe you credit limit increases when the current from new information or you payment probability.
Exactly. As I'll say in a minute, there's not much repricing or changing of credit limits over time. There is a little bit more changing of credit limits over time. Like I think 2 years post origination, 20% have a different credit limit, but 80% have the same limit. I try and focus on the short run horizon. I think lenders probably, the switching story is a big deal here. I try and look at individuals who don't have a card already and estimate the model on them. So to avoid these difficult questions about repaying multiple cards, switching, all these complications I'm trying to avoid, but probably are quite important in general. Yeah. All right, so my data come from the regulator in the UK. They did a market study on the credit card market, which is online, the UK credit card market. For that, they asked 14 lenders to give their entire portfolio of credit cards that were active at some point between 2010 and 2015. So for which there's a statement, a credit card statement in that period. They then go back and say, all those cards that were active in that period, we want to know at the point when it was created, that individual's card, when it was created, what was their interest rate, their individual interest rate, and their individual credit limit. What were their demographics? How old were they? What were they employed? What's their income? And the nice thing about the data, and actually quite important for my paper, is that the lenders had to report the risk score that they assigned to the customer. So we don't have like a FICO in the UK either. Lenders, and I'm going to show more evidence of this later, create their own risk score. And the lenders had to report that. So without this, it's quite difficult to know if lenders are doing risk-based pricing and risk-based credit limits or not, because if I don't know their assessment of risk, I can't tell whether they're tailoring to that score. So this is a nice advantage of the data. So about 74 million credit cards were active in that period. And then for each of those cards, so each individual that has their card, I get a panel of statement data about that card. So it's usage over time. So I know the opening and closing balance, how much interest was charged, the interest rate over time, the credit limit over time, the number of transactions. So this is not transaction level data. I don't know each individual transaction they did, but I know everything you would otherwise see on a credit card statement. I know whether individuals did repay anything or not, by which I can start inferring whether they've been charged off and default. And a really nice feature as well is that lenders had to report the cost of each at the statement level. So they had to report the funding cost for this customer, loan loss provision, fixed costs as well. So this is like very rare in data, and I can actually see the funding cost that the lender faces to serve a customer. And then so this is the main part of the data, the origination level data, the statement level panel, and then a couple of other sources I complement as well. I have a panel of the card characteristics. So if you imagine like Santander has a premium card, over time I see what is the interest rate they're advertising on the card. Obviously that's quite important for me to know if customers are getting what's advertised. I know the reward structure of the card over time, and I know the income threshold as well. So these income thresholds are going to be quite important. You have to have a certain income to qualify for some cards. Many cards don't have an income threshold, but the more premium cards, you need to have a minimum income to qualify for it. So they're going to be part of the story as well eventually. And then I have a small data set that's only has 2 variables really, which allows me to match cards to individuals. So it says, an individual ID and a card ID. So I can match cards to individuals and calculate these things like how many cards does each individual have. And then very interestingly, they ran a couple of surveys as well, asking customers, why did you pick certain credit cards, which provides a little bit support to some of my modeling assumptions that I'll talk about. Are there any questions on the data? It's quite rich, obviously, and it allows me to unpack a lot of the story here. So here's 5 facts which are important, and unfortunately, in giving this talk, I always get asked usually about 4 of these before I get to them. So I've answered a few of these already, but it's very important background details. Now, the first one that's obviously important for me to say is this paper's about credit limits, but if they didn't bind, then there's not really a story here of interest. So and they do bind. So if you look at the statements, the credit card statements across all customers over the whole time period, of those where the card is actually used, around 1 in 4 will be using 90+% of the credit limit. And this is typically how people classify being credit constrained on your card, on that particular card, because if you've got $20 left, and that does limit you, you can't buy something that's $50. So you are at that point considered credit constrained. And so 1 in 4 have a 90+% utilization. Actually, the number that might experience you to credit constraint would be higher, because I don't see the balance day to day. This is at the start and the end of the month. So maybe some customers are using the entire limit in the period and then paying some off, and I don't see that. So this is almost like a lower bound on being credit constrained.
Still the limit can bind, and you're not using it all, right, because of risk, and you want to have some amount without using it.
Say that again. So
I guess you will have a idiosyncratic risk here. You will always want to have some amount available for a credit card. So even if you are not in the 90%, it can.
You might still be. Yes. Yeah, of course. And what I thought you were saying actually though is that you can actually go over your credit limit, but they'd start charging loads of fees. But I don't see that happening too much in the data. But yeah, exactly. So that's even more of a lower bound. So yeah, so that's across statements at the individual level. Nearly half of customers 2 years after origination have nearly hit their limit at some point. So this is 40% of customers utilize almost all of their balance at some point in the 2 years after origination. The market in the UK is a little bit more placid than it's a lot more placid than in the US. So you can't get really good rewards here in the UK on credit cards. There's basically no fees. This helps me a lot. There's basically no annual fees on credit cards. So limited rewards in the sense, to be more specific, maybe 8% of card months feature some reward. 92% of card months have no reward at all. No cashback, no air miles, for example. And the 0% purchase periods are very short as well. Maybe you get 3 months at first where you don't have to pay interest at all. But that's also only on a few cards can you get a purchase deal. Tricia is telling me that merchant fees are more important than interchange fees here, but what's underneath a bit of this also is lower merchant fees. In the EU, there's a regulated cap on the interchange fees on credit cards, so you can't have a higher interchange fee than 0.3%, whereas in the US, we know it's actually more, perhaps nearer 3% that is used as the interchange fee. So, I guess the story here is that if you can't make a lot of money from, as was being asked earlier, you've got some customers who never pay a penny in interest. They're going to use their credit card a lot to try and build up rewards. If the interchange revenue is low, then you're not profitable in these customers. So you can't give all these nice rewards if you have customers like myself and some others who never pay a penny in interest, if you can't charge interchange, make interchange revenue. In the US, if you can make more interchange revenue, you like safe people because you make money when they use the card. They don't revolve, but they still maybe make you some interchange money, and so you can incentivize them through rewards. That's the story there. This was asked about earlier. So in the US, there's the paper that's saying that lenders nowadays aren't allowed to reprice customers so much. In the UK, there's no such regulation, but only about 10% of customers have a different interest rate 2 years after they've got the credit card. So the repricing is limited, and 80% of customers have the same credit limit when I look 2 years after origination. So I'm not saying the dynamics aren't important, but I think it's in the paper, if I have to make simplifying assumptions, I'm going to not look at dynamic repricing in this paper. This stat's important as well. So you might have in mind, a good question would be, well, maybe lenders give everyone on the same product, the same interest rate, but maybe they just offer 20 credit card products, and then they just sort out all the customers onto these different products. And I don't have a really good answer why they don't do this. Maybe it's costly to have a big menu, and there's theoretical papers that rule this out as well. The kind of the self-selection models of Rothschild and Stiglitz kind of story we know about doesn't necessarily apply when individuals can have multiple credit cards. And I guess theoretically that's the answer. But most lenders only offer free effectively, when you weight by market shares, only really offer 2 or 3 cards. So there's definitely, for some reason or other, there's not this story of offering just multiple cards and sorting individuals onto products. And as I said before to Enzo, most individuals have 1 card, have 1 card, and some have 2. But this is not like the US.
So I'm kind of surprised that they don't adjust the limits. I mean, I'm using the data, but do the banks know a lot about these customers before they appear? They were customer for their client
I think most credit cards, which is what I understand happens here, a lot of them actually happen when an individual gets a debit card. So you go in to get a debit card, they say, by the way, do you want a credit card as well? And they give them one. So in that case, they won't have a good history on them.
Yeah.
But then, so I guess that's like what you're saying, they would want to reprice, right? Change the credit limit. There is some regulation that might be relevant for this story, which is that you actually have to ask a customer if they want an increase, and it gets a bit sticky because there was a lot of discussion about unsolicited increases and kind of like encouraging people to over borrow through just giving them more than they want. And it's a weird story, but there is some regulation that's linked to that maybe we could talk about later. I can't remember the exact details, but maybe that's relevant. All right, so to make the institutional environment more clear, so just to say it one last time, this is actually, so let me show you through the picture. This is from HSBC's website. That's one of the main banks in the UK across the world. So if you go to their website to get a credit card in the UK, you're shown this product, and they have to, by law, say, well, if you want this, then there's the representative APR that they have to say, and that's the number that's relevant here. So that's them doing the advertising of it with their product. And then, as I said, the majority of customers must either get that or something lower. And the key fact, which I've been alluding to, but to hammer home, is that you go into the store and you say, I want this credit card. And you can't say to them, what interest rate are you going to give me? Because if you do that, they'll say, well, you need to apply to find out. Like, they can't work it out until they've gone through all the checks on you. And so that's the story I was saying earlier, that the government is concerned about that and want an advertised rate that is meaningful. And so you have to say, yes, okay, fine, I'll have the credit card and I accept the deal. And then 2 weeks later, they send you the plastic in the post and a letter says, by the way, your credit limit is this and your interest rate is that. And obviously it's clearly costly in terms of time and effort to get multiple credit cards. You could say to me, well, Will, why don't people could just go into every single bank, originate 10 cards and see which one gives them what they want and throw away the rest. You can't do that either, because every time you apply for a credit card, it's marked on your file. Okay, and it's marked on your credit file, and they quickly stop you from originating loads of cards as well. So it's a sticky environment, and things. I'm not saying this is optimal at all. You might say, well, that shouldn't be the case. We should allow a shopping period or something like that, and that's maybe true, but this is the way it works in the UK. Yeah.
This is a kind of weird question. One way you could sort of undo this, or the bank could undo this, or the customer could undo this limit, is by having a different product, like a term loan with a proper, with a risk-based interest rate. Every time you use your card, I'll get you a loan with your risk-based interest rate. Let's just repay the card, you get the loan. Does that make sense?
A little bit. Maybe are you saying basically that we should think about other credit products?
Right.
Yeah, I guess the only thing I can really say about that is it's very uncommon to have, like, for maybe for risky customers more common, but term loans are not really like highly used product in the UK. And for some reason or other, credit cards are the unsecured credit. Yeah, maybe I didn't understand 100%. Yeah, so did I start? What time did I start?
4. You started at 2:30?
2:30, so that's 40 minutes.
Yeah, 4.
Good. Okay, so that's the data in the institutional setup. It's kind of like valuable to understand that before we go on. So I'm going to have 4 patterns in the data to discuss what I see in the data before I go to the model. The first is to provide some evidence that lenders do construct their own risk scores. So this is not like a FICO score world where banks, can see the FICO score. Everyone has a FICO score. No, in the UK, if you want to go to a particular bank and get a credit card, they'll create their own assessment of your risk. I'm sure some US lenders do this as well, of course, but the FICO is kind of well known. We don't have an equivalent, like, well-known FICO score that people care about. So one thing I see first and foremost, which is not so interesting, but just starts to tell us that lenders are constructing their own credit scores, is they're all on different numerical scales, and the distribution of them looks very different across lenders. Now, that's not very compelling, but it's a starting point. Of course, lenders could just rescale, so this doesn't tell us that they're different in any way at all, but it is there in the data. These second and third bullet points are the more compelling ways to say that these scores differ across lenders, and they're constructing their own scores. So what I do is I take each lender and I regress their measure of risk that I see in the data on all of the observables that I have, which you fill out on the credit card application form. So, and I do this very flexibly. So I try all the machine learning tools you could think about: regression, random forest, everything, boosting on the demographics I have. And the R squared you can get are rarely bigger than 33%. So they range across lenders. So some is as low as 7%, others up to 34%. So what this is saying, well, there's some lenders out there, and where you can explain a third of the variation in risk scores with basic things like income and age. So those lenders, they take in these demographics and they just combine them in some way to create a risk score. Whereas there's other lenders where even with these basic demographics, you struggle to explain a lot of the variation in risk scores. So just coming back to the question earlier, there are big lenders. It's the bigger lenders who are more sophisticated. They're trying to build in the credit history and everything they know about someone across all of their credit portfolio, across their whole balance sheet to assess their risk. And there's good papers in the US showing that this is what lenders are trying to do, to use credit histories to assess how I should assess someone's risk. So some lenders aren't using these basic demographics so much in their risk score. Now, what's more interesting as well is I do an ANOVA, and I'm going to do these analysis of variance, talk about them on the next slide as well, where I decompose the variation in a lender, the total variation in their risk scores, into a within card component. So that's like on a product, how much do the risk scores vary? And there's another term, which is the between term, which is like how different is the average risk score across the products. And what I find is that almost all of the variation in credit scores at a lender is within a card. So on a given product, like in a Santander Premium, there's a lot of variation in the risk score. It's not the case that on each product, everyone has roughly the same risk scores. That's not what I find. So even the sorting seems very limited here. And again, this is an interesting finding, but basically you have on any product, you'll have some customers who they classify as very safe, for whom they'll give a larger credit limit, and some they'll classify as risky. And so what is the implication for this for the model is that if I'm going to have a risk score in the model for lenders, because if I want to try and model risk-based pricing and risk-based credit limits, then these should in some way be allowed to vary across lenders. And that's one of the modeling novelties. This is the kind of slide where you have the key finding in the descriptive finding in the paper. So I do, like I just said, I do this analysis of variance on every other variable. So fees and rewards and credit limits and interest rates. And so what I find is there's literally no variation within card variation In rewards, if you have a card and someone else has the card, you're guaranteed to have the same reward structure, and you're guaranteed to have the same fees, and you're guaranteed to have the same promotional deals. There is very limited, if any, I shouldn't say no perhaps, but very limited within card variation in interest rates, which is exactly, well, it's much stronger than what the regulation says. If you calculate the proportion of people obtaining the advertised interest rates, at some lenders it's 100, everyone gets the advertised rates. At most it's at least 80, if not the average being close to 90. And there's also limited between card variation in interest rates. So, you know, if a lender offers free products, there might be some difference in the interest rates across those cards, but not a lot. And even across lenders, there's limited variation in interest rates, which really surprises me. Obviously, this is not the subprime lenders who have higher interest rates generally, but on the main banks, most of the interest rates are around 19 to 25% APR. And there's not a wide variation in that. And, you know, one thing I investigated about this, because this is quite coincidental, is whether there's collusion. I didn't do a really rigorous analysis of potential collusion here, but the limited analysis I did said it wasn't consistent with collusion. But there is, it is smelling a little bit like collusion on interest rates here, I would agree. So that's the story there. And now the key fact, though, is that there is substantial, even within card, variation in credit limits at lenders. So, and these are based on risk. So when I plot the average credit limit against the risk score, you see these, well, that would be, you'd see a downward sloping curve. In that case, higher risk, lower credit limit. Let me show you. So here's the only picture I have for the descriptives. What I do is I plot the credit limit, essentially the empirical credit limit distribution. In maroon here, the dashed line is one lender in the data, and the golden smooth curve is a different lender. And you can see two things stand out. First, there's clearly a difference in the shape of these distributions. So you have one lender, B, they're a smaller lender. They only offer about, they have a discrete function here. They only offer about 15 different credit limits, to 15 to 20 different credit limits across all their customers. And so they have this kind of coarse assignment of credit limits. Like if what they're doing is they're saying if your risk scores between, 100 and 200, you get a certain credit limit, 200 and 300, you get a certain credit limit. So it's not very finely tuned. They have these coarse bins, and they don't try and tailor the credit limit too much. That contrasts with lender A, where you can imagine, I don't know if it's what they're doing, but you can imagine it's like doing a regression where you just give someone the predicted value. So they are literally tailoring the credit limits to a £5 level based on their risk prediction. So super fine distribution of credit limits across customers. So that's the one difference. You see a continuous curve for one lender with all these tiny little jumps along the percentiles, and a discrete curve for a different lender. And the other lenders, these are the two extremes. The other lenders are somewhere in between. And that's one difference. The other difference you can see is the scale. The lender B doesn't give many people higher than that's probably around $7,500. Everyone has lower than $7,500. Whereas at this lender that's bigger, they are giving some people up to $20,000. This is pounds. That's why I'm doing the numbers as I am. Up to about $20,000, and some people are getting about $200. So they really do have a wide range and difference in scale. Much bigger average credit limits at this lender A. So in the model, again, I'm going to have to try and explain these differences in distributions across lenders, and the intuition is going to be based on the difference in credit scores. So the idea is that lender B is not doing something too finely tuned. So it's because they don't necessarily try and build a really good credit scoring model. That's going to be the exogenous driver of this. So that's that. And finally, let me just say about this quickly. I want to see whether there is actually evidence of asymmetric information in the data. So I implement a kind of old school asymmetric information test, where you essentially estimate a pair of probit regressions. And what you do is you take a probit for explaining individuals if they default or not, which is defined as 3 months of not making any payments in this industry. And I do another probit of whether the individual is revolving the full balance. I also do it if they're revolving any balance. And the X's here are like all the observables on the individuals that I have in the data. And the story then is if the lender has the X variables, then the epsilon is meant to represent the things the lender can't see about the individual, which drive whether they default or not, and drive how much they leave on the balance unpaid. In case I wasn't clear, revolving here means it's the amount of money you don't pay on the credit card. You roll over each period. So it's how much you're not paying. That's the amount on which interest is being added. And so what we want to do is say, well, these epsilons represent the unobservables that drive how much the individual borrows and whether the individual defaults. And the idea is you look at the correlation between them. And the correlation I estimate is 0.15, very significant. Obviously, I have a lot of data, so I'm not worried about that. But the positive value here, what that means is that those individuals with an unobservable that makes them want to borrow more also have an unobservable that makes them more likely to default. And that is not quite exactly what people call adverse selection traditionally, but it's something like an intensive margin adverse selection. But it's more about those who want to borrow a lot have unobservables, which drive them also potentially to default. And so there's been a long literature kind of not too keen on these tests, but at least there is some empirical evidence consistent with the fact that asymmetric information is important. And so I want my model to have unobservables for borrowers, both in the default and the borrowing level. Let me skip that and come to the model, but yeah, questions? Sorry?
Only more a hazard.
Exactly. So we don't know exactly what this is. It's some combination, but the fact it's positive means it could be. You can see one of my other papers if you want to. I do some other work on this, yeah, in other work. So talk about that. Yeah, so basically, I laid out the landscape now, and the idea is to take these facts that I see in the data and embed them into a model that will allow me to understand and quantify the costs and benefits of the story we have in the UK environment. And for that, there's no, I haven't had much identification yet. I've not had an instrument yet or looked at something causal. This has just been descriptive. And so let's move to the model. So demand side is relatively following the literature here. There's this well-known Crawford-Pavnini-Shivardi paper for Italian credit products for firms, and I kind of follow relatively closely what they do on the demand side. So the innovation in this model is not on the demand side. It is kind of a little bit reduced form, but the benefit of the reduced form nature of it is, I think, is that there's so many papers about behavioral economics and behavioral factors in credit card markets. And by not having an explicit structural model on the demand side, I'm agnostic to whether individuals have certain behavioral biases or not, and I don't have to worry about whether they do or don't. I'm just looking at their revealed behavior. And so it's a little bit more reduced form, which has limitations, but at least means I don't have to worry whether I have the right model of behavior. So what happens first is that individuals have a discrete choice over which credit card to pick. So they're looking out there, maybe they want to have a Lloyd's, they could pick the Lloyd's premium or the Santander premium or the HSBC card. That's a discrete choice. There's two parts to that. Well, one is they have a utility for picking a certain card, and that's based on the advertised interest rate and whether the card has rewards or not. Yes?
Excuse me, what is the outside option of the utility, the choice side?
Question. Because I don't have data on not getting a card, I have to just set a representative outside option here. But it's a little bit more complicated than that, because this is about people who revolve a balance. And so I actually have a nest for transacting behavior as well. And so that allows me to get out of it, because it's a good question. I wish I had data on individuals without who didn't pick credit cards. I just don't. I have to live with that fact. But a good question. So yeah, individuals have utility over certain credit cards, and this is very consistent with what I see in the survey evidence. So the surveys ask people, why did you pick the card, this particular credit card? And they ask thousands of people, why did you pick the card you chose? And people write down their responses. The most common answers are because it had a low interest rate, because it gave me some rewards. Basically no one says because it gives me a good credit limit. And it's consistent with the fact there's no way to find out what credit limit you're going to get a certain lender. You might have an idea that American Express is going to give you more than a subprime bank. Fine. My model can cope with that because I have card level fixed effects. So that is going to contain potentially the average credit limit at each lender, but you don't know your individual specific credit limit at lender, and people don't say that's why they choose certain cards. So I know that's quite a strong assumption, but it's why I make it. That's the utility. The choice set is from these income thresholds. So the set of cards you could pick is the ones where your income exceeds the threshold, so you won't get rejected. That's the first equation in the model for demand side. The second is then for those who pick a card and use it for rolling a balance. I'm going to have a setup that's like this top-coded Tobit models. Maybe you remember that from your econometrics. It's like the problem is some people hit the credit limit, so I don't know for them what they would like to have borrowed in the absence of the credit limit. Whereas for the individuals who use much lower than the credit limit, I can say, well, that's the amount of revolving they would do if they weren't constrained, and I call that the unconstrained revolving. This is B star in the model. And the unconstrained revolving will be a function, again, of the interest rate. So this is going to allow me to have an elasticity of demand in your borrowing choice. Again, maybe some card features, but also your income is going to be a factor that determines how much you want to leave unpaid. And here's the key thing, that I have this unobservable epsilon IB, just like in the empirical stuff. This is a factor that the individual knows, but the lender doesn't know perfectly about the individual. So you can imagine someone loses their job. They know they're actually going to lose their job. They don't tell the lender this, but they know this is going to mean they need a credit card to borrow. And so the lender can't work that out perfectly. They're not told that the individual's about to lose their job. So the lender doesn't know it, the individual does know it, and it's going to drive their likelihood to borrow. Now, the key thing to add, really important, I don't have it on the slides, but it's important, that these preferences over interest rates, both in which card you pick and in how much you leave unpaid, are heterogeneous across customers. So I allow them to vary across individuals. If you know the kind of BLP demand estimation setting, it's like the sensitivity to the interest rate varies across customers and is allowed to vary by their income. So I estimate that parameter. That's the key parameter that I was talking about earlier, that tells me whether those that have high income are more or less elastic to in their card choice and their borrowing. Final equation is the simple kind of probit equation for whether you default, pretty similar actually to what I showed you earlier. The net utility from defaulting depends on your income, which is known to the lender, and your unobserved preference for default. This is like the one here. It's like, as an individual, I may know again that I'm going to lose my job and I've actually got some debts which I'm not telling the bank about. Maybe I owe a friend £1,000. I know that, the lender doesn't know that. That's going to make me more likely to default. The lender doesn't know this perfectly. And that's the story here. I make, again, assumptions that some people are uncomfortable with, but there's very good evidence to suggest on credit cards that the interest rate doesn't drive default. In mortgages, this is clearly not the case. We know in mortgages that there's a big effect of the interest rate on whether you get in trouble with your mortgage. In credit cards, there's building evidence that the interest rate doesn't, at least on the margin, changes in interest rate don't change default probabilities. And I have some evidence in the paper also that credit limits don't seem to have a causal effect on default. There's more selection rather than treatment here. So obviously, those who default have lower credit limits. In fact, they have lower credit limits because they're risky, and that's what I see in the data. So it's hard to think there's a strong causal effect. Now, the key thing to make the model simpler is that I'm going to have one epsilon term, which is going to drive both epsilon IB and epsilon ID. But I'm not imposing any structure. I'm imposing a little bit of structure, but I'm leaving the correlation between epsilon B and epsilon D to be estimated. So the positive correlation between these two epsilons in the model would be adverse selection, and not moral hazard in the model, it would be adverse selection. And so I'm leaving that to be estimated. But I have this common component so that I can have a risk score for the lender, basically, as well as 2 notes.
Sorry, you can go back when you say. So given that there's no, that you don't observe individuals not choosing credit cards, I guess that's the reason why you're not allowing the credit card choice and observed component to be correlated with the rest, right?
Yeah, exactly. Because this is not
right.
Exactly. That's exactly right. Because if I had an outside option that was not choosing the card, I really would want that term. Because I don't have it, it's actually a bit superfluous, in my opinion.
Right. It's not. I mean, you're not going to think that the unobserved component of revolving and default is gonna be correlated with your preference for Santander
Exactly.
card.
Exactly.
Yeah, I
Exactly.
understand.
I'm glad you see that because many people don't. All right, so that's the demand side. Free equation model. I have to estimate this jointly because there is at least these unobservables driving revolving balance and default. I also have to deal with the fact that there's a top cap on credit limits, so I need to use the Tobit kind of idea in the likelihood. So it is still involved to estimate this, but it's free reduced form equations basically. No optimization for the borrower. That's the result of the optimization is what I model. On the supply side, it's different. So this is the exogenous feature about lenders. They have what I call a screening technology, and this provides them with a predicted distribution of a customer's epsilon. So I normalize epsilon to be standard normal. That's innocuous. So this epsilon term is standard normal in the population. So everyone gets a draw of their epsilon from the standard normal, and higher epsilon means you're more risky because it means that's going to increase your borrowing level. And here's an example where, so in this curve is the population distribution, and you can imagine that someone has a value epsilon check here. So that's their value for a given individual. They know that value, the epsilon check, the lender doesn't. What the lender gets is they're told by their machine that the machine says, well, it's likely to be close to, they think the machine, the prediction, the screening technology says, I think it's close, it's centered around epsilon, E. So this is the central point, the signal, but it could be, this is the predicted distribution. So it's possible that it's maybe slightly lower, maybe slightly bigger, but it's very unlikely to be close to zero based on the prediction. So the dashed line is the lender, what it predicts, what it thinks is the likelihood. It's a bit like a posterior in some respects in a Bayesian world. And it has two components. It has the 0.45 here is illustrative. Don't pay any attention to that. It has a signal, which is the central point around which it can be based, and a variance as well, which is a precision sigma L. And the key thing is that each lender, I'm going to estimate the E, the set of E's that they can see, the signals. So each lender is going to have a different set of these E values and a different number as well. And that number is going to be very closely tied to the set of credit limits, that the distinct credit limits they offer. And that was the motivation why I showed you these different distributions. One was kind of like a step function and one was very smooth. So the smooth lender, the idea is conditional on income, they need to have many different values of these E's in order to generate a smooth distribution of credit limits, because the credit limits are going to come based on these predictions of customers' risk. So I'm going to estimate the E's and the precisions as well from the residual variation. The lender's going to maximize profit when they make their choices by taking expectation over a customer's predicted risk distribution, the screening technology provides. This is exogenous. Each lender is given it. Obviously, in practice, this is really not an exogenous object. Lenders can invest over time. But for the sake of the model, I'm going to keep this as something they have and not a choice about how good their technology is at a given point in time. I think that's reasonable to make. Yes, now that's the exogenous part. What's the endogenous part for the lender? They're going to pick, the timing is as follows. They're going to pick the advertised interest rate. And this, I don't worry about too much, but this, if you know, is a bit like the Bertrand-Nash model, where the lenders are choosing these advertised rates, advertised interest rates to maximize profits. And it's kind of like a game theory model. You're picking the interest rate maximizes your profit given everyone else's advertised interest rate. That's like the standard IO model of how to do pricing. This is the advertised rate. That's not new. This is where the kind of novelty starts to come in, both in the screening technology and this bit. The lender's going to choose each customer. So once a customer chooses their card, the lender then is going to pick their credit limit, B bar, and whether they're going to, and how much they might deviate from the advertised rate RJ, and I call that ZIJ. So this is by definition, an individual I's interest rate can be written as the advertised one plus the deviation from the advertised one. That's true by definition. And the key thing in the data is in the rare occasions where lenders do set a strictly positive Z, so when they do give someone higher than the advertised rate, they're always positive. they basically never deviate and give someone a lower than advertised, which again is an interesting fact, but I'm going to use it in the model to have this as an inequality constraint. So they're either picking Z equals 0, and we know in the data they do this for 90% of customers, Z is 0, but there's a 10% where they pick it as something strictly positive. So the profit, so that's the interest rate. I have two or three more equations, and then we're done, I guess, with the maths. To build up the lender's profit, we start by saying, well, what is their profit for each unit that is left unpaid? So for every pound that the individual leaves unpaid on the card, the expected profit is as follows, pi. They need to pay the funding cost on that unit to be able to lend out that unit. So it's the funding cost, and then with probability 1 minus P default, which comes from the demand side, they get the interest from that customer, and with probability P default, they lose the customer defaults, and the assumption is they lose the entire unit. So in practice, they can recover some of the balance when customer defaults, but I'm just going to make the assumption that they can't get any of it. So that's the profit per unit borrowed, and then the profit overall is naturally going to be the profit per unit borrowed times by the amount that is actually borrowed. And why does this look complicated? Because it depends on the credit limit. So remember, the lender sets the credit limit, so it controls the latter term. If they set a credit limit B bar that's higher than the amount the individual wants to borrow, then this is B star, so that's the minimum. Because so suppose someone wants to borrow 1,000 and you give them 3,000 credit limit, and B star is how much they want to borrow, so it's just pi times 1,000. But if you are going to make them credit constrained, if they want to borrow 1,000, so B star is 1,000, you set B bar as 500, then they're going to use 500, and then that's going to be your profit 500 times by pi. So you have to deal with this non-differentiability, which looks like it makes things actually quite complicated. It turns out it doesn't, and you can get a first order condition out of this, which is I guess I was very happy when I found that out. So that's the overall profit you get from someone borrowing, gross of the individualization costs, which are coming in the final part next. The idea to make the model glue together is that there's this shadow cost if you want to individualize a customer's interest rate, capital C, which is an increasing and convex function of the amount by which you individualize their interest rate. So if you individualize a customer's rate by a lot, then there's a shadow cost of that, because the idea is you're annoying them by more. This is the modeling assumption I make. And obviously C of 0 is 0, because if you don't individualize a customer's rate, then there's not a cost. And then the profit is just going to be over all the customers. This is the key thing. Over all the customers that you serve, you need to pick their credit limit and deviations from the advertised rate. Remember, you've already set the advertised rate now. Why do I need to do this over all customers at once? Because there's regulation about how much I can individualize customers' interest rate. So I want to maximize my profits over these customers on card J, the profit I get from the customer minus the cost of individualizing their interest rate. But they're subject to the constraints. The first constraint is that it's either going to be 0 or something positive. And the second is this regulation requirement. This basically says in maths that the proportion of customers that I give a strictly positive deviation to can't be more than 50%. So this is like the 50% limit. So this is the proportion of customers that I give an individualized rate to. Needs to be less than the regulatory requirement.
I don't understand why you fix that because of data. I mean, you're in so you're not allowing the lender to do some other strategy that allows them to charge less interest rates. Some people, right?
Yeah, I mean, well, it links to the fact that I have a cost for this. You're probably saying that I guess there might be a benefit for giving lower than the rate, or that right, or even outside of profit.
So if I am forced to set only one rate, probably I will set up a high rate than for many customers.
Mm.
And then afterwards, I will lower them to some of them over time.
Yeah,
you're saying that you're not allowed that in the model because you don't see it.
It is a restriction. I understand. I guess all I can say there is, and you probably might like this answer, but given that there's nothing of it in the data. The benefits of doing it must somehow be there. So must somehow be small. And I'm not including that anywhere here. It is, being honest, a little bit about making the technical details work. I can't necessarily make it work without this inequality constraint. So there's always a cost to making the maths work. But it, a more general model would allow for going both ways in principle. Yeah. Now in the counterfactual, all of this is going to go, so they can and do set below and above. So it's not a restriction on the counterfactual, but it's a restriction on the baseline model. Yeah.
So the counterfactual will be without the C.
The counterfactual will be without the C and then without anything on this line. Yeah. This bottom line. No regulation, no Zs, no costs of Z exactly.
Can I so can you one slide back?
Yeah, I just want to think about this question a bit more if it's okay. So
So the cost, the last equation, you can write up.
I'm done. Yeah.
You don't observe that, but you're gonna
This,
recover that,
this,
right?
no,
You don't observe it?
I
But you don't
observe funding costs.
Oh, okay. So that's data.
Yeah. Yeah. Otherwise, the challenge would be a lot harder to separate things. Okay, so how am I doing for time? Okay, I'll speed up a little bit, but just to quickly about this, you get a first order condition for individualizing rates. There's a Lagrange multiplier on the constraint, the inequality constraint. That's going to be 0 for anyone you give a positive deviation to, which means in that case, if you ignore the lambda, this is very intuitive that the marginal benefit from individualizing needs to be equal to the marginal cost of individualizing, just as we would expect. That's like a standard optimality condition. And therefore, if what I do is I choose a functional form for C, I just do like a linear case. So there's a marginal cost of individualization. Therefore, the derivative is just this kappa. That's the marginal cost of individualizing interest rates. And therefore, the derivative is just kappa here. And I can calculate this left-hand side. So in estimation, once I've estimated everything else, I can actually calculate this term, and I can calculate the set of kappas for those that have an individualized rate, the 10% that get an individualized rate. The first order condition for the credit limit turns out to be nice, and you can write out the maths and differentiate it, make it work. What the intuition here is that you want to set credit limits such that the expected profit per unit revolved is 0. This is a bit like a marginal profit on a customer, but conditional on those that are going to look to use the entire credit limit. So this is not a 0 profit condition. Lenders do make profits because they make profits on the inframarginal customers. What they want to do, though, is they want to optimize the credit limit for those for which the credit limit is binding. That's the marginal customer you care about. What is the optimal credit limit for them? Well, it should set the marginal profit on that unit to 0. Otherwise, if it was positive, I should be giving more credit limit. Negative, I should be cutting back the credit limit. So this is not, some people have been confused before about whether this is saying there's no profit. This is the fact that this is conditional on those that would be using the entire credit limit means that it's not a 0 profit condition.
Can I say, so if we think that the cost of individualizing interest rate is, related to the advertising thing, right? The shoe example. So how can we think about this cost being individual specific?
The idea is that some people, well, actually, I will come to that later. Some people don't even know it's happening to them. Some people don't care about it so much. Some people are outraged. I could do the model and have a constant cost per lender, but what I'm actually going to find is quite a lot of variation when I estimate it. That's a kind of...
Actually, that's where my question is. So when you estimate that, I would expect you would find like huge costs for all the people that, stick with the average interest rate. Then you would find like very low costs.
Right.
So a little bit.
I can't estimate those though for those that get the advertised rate because so I can't do that. So that's the set I estimate is the set. It's a lower bound exactly.
Right.
Because I can only do it for those that lenders choose to add to individualize, which they're not. Those are probably going to be the ones all else equal where there's a low cost. So yeah. But yeah.
But my point is like you would have you would expect like a huge cost for a lot of people, right? But then, and that cost goes down.
Yeah, it could be
You go a
discrete.
little bit.
Yeah. I probably should try some robustness to this. This is the brand new part actually that I've just added recently. So, I didn't try it any other way, but maybe I should try some discreteness or try some different forms. But yeah, it's non-parametric in that sense across individuals at the moment. Yeah. Good. Let me just move on from this. It's not so interesting. This is where things get a bit more interesting. The technical details are over now. So I stopped 15 minutes, right? Yes. Okay. Let me skip the estimation, but I have time this afternoon or tomorrow. I have an interesting instrument. I'm happy to talk about this story, but let me skip it just so I make sure I finish. Let's just move straight to the results. What I estimate on the demand, so the demand side estimates, remember I said I allow the preference over interest rates to vary across individuals, and I find large variation in interest rate elasticities across individuals. So the parameter on the income is quite sizable, and it tells me that low income individuals have less elastic demand. So those that have low income have inelastic demand, both when they're choosing the card and when they're choosing how much to leave unpaid. So there's many stories for this one. I was told yesterday, which is a good story, is it's possible if you can't access any other form of credit, then you can't really afford to be too elastic to the interest rate they give you. But also, I think there's something more broad there, which is just that if you need to get something for your kids and you have no other sources of money, then they put up your interest rate, you're still going to buy the necessity. So this is consistent also with the fact that the demand, the elasticity estimate is really quite inelastic, and other papers have found this in credit cards. So again, I don't know about mortgages comparisons, but there's now a building bunch of papers saying that generally credit card demand is quite inelastic to the interest rate. And there's many stories here about salience, whether people understand interest rates and all these kind of things that could be flying around that are interesting.
This can mainly from across cards, right?
The card choice.
There are differences.
Yeah, but are you talking about the average level or the
variability that you use to estimate this?
Right, I observe
from mainly because inside the same card it's just only the APR, all
right.
Always.
Yeah, exactly. Right.
So it comes from different.
Yes, exactly. Yes.
Still, there may be some banks that borrow to some clients on some low
income. Yeah, exactly. So for a given income, it's that choice. Yeah, exactly. That's what's identifying it in the data. Actually, well, I'm happy to talk to you about the instrument afterwards because there is some endogeneity problem that I do.
So there might be selection here that you fix with the instrument.
Yeah. Good. Yeah, exactly. So there is an endogeneity to concern here, and I do address it. So yeah. Now I find quite large intensive margin adverse selection. So the correlation I estimate from the model between these unobservables is higher, is 0.38. So in the data it was a little bit lower. The model value is larger here. And again, other papers recently, business credit cards in the US, US credit cards find something slightly lower. So this probably is slightly higher than the truth, but that's the number I get there in the model. And the model fit is surprisingly quite good here. I've quite rich data, and I fit the market share distribution quite well, the revolving distribution quite well. So that's good stuff. The supply side estimates. Remember, I do the screening technologies by lender. And I find that across lenders, there is variation in how precise their screening technologies are. Here is an example of two screening technologies. So you can see this lender, remember this is the standard normal. They're getting signals on the standard normal. So every one of these lines is a different signal they can get. And they have many different values here. It's quite a fine distribution of potential signals, whereas there's another lender on the right-hand side that doesn't get quite so many signals. I guess what's interesting on the one on the right is that the signals they're getting are on the higher end of the risk distribution. So this is all exogenous in the model, but they have a more fine, they have some fine granularity in the high risk signals and less on the safe side. So, but you can see this is the stuff that comes out of the model. What's really interesting and nice to think about is this correlate. This is only a correlation, but it is interesting. You know, I would have, if you'd have asked me before I estimated the model, I would have said that the lenders that have really good screening technologies would have safe customers. Because you would think if you've got a really good screening technology, then you can pinpoint exactly who's safe and you would want them. Now, that's not what happens. And the reason why is because you have to remember that you can't make much interchange revenue in the UK. You don't make much out of really safe customers. You have to be willing to take on the risky customers. And so that if you have the lenders that don't have a good screening technology, they can't do that strategy though. So the ones that have really precise screening technologies are going to say, we're willing now to take on the people who are going to revolve a balance and make me some interest, but I'm going to give them a lower credit limit at first and see how they behave with it. So they can tailor their credit limits sufficiently and serve a riskier clientele. So I thought that was quite neat. Now, what's interesting here as well is I'm just looking at a correlation here. In practice, this story could be two ways. It could be that for some reason, this is a lender that serves risky customers and endogenously they invest in their screening technology. It could be that for some reason they have a good screening technology and then they serve a riskier clientele. So I can't do causality here. It could go either way. I think there's some more interesting work to be done there. And there's a paper by a recent job market candidate at Stanford who actually is doing this a little bit more seriously. An interesting paper by, I think it's Susan Cherry, recently on the market, who does this a little bit more. I'll be interested to look at that paper soon. So the final results is I estimate these marginal cost of individualizing. And as I was saying, I can only do this for the customers where they do have an individualized interest rate. That's only 10%. So this is a lower bound because we expect probably that the customers for whom there's a really high cost of individualizing is the ones we wouldn't be likely to do it on. And I can't estimate them. It's a conditional distribution, what I get. But what I find is that if you want to give someone 5 points higher than the advertised, so imagine the advertised is 20 and you want to give them 25, then that's on average, that's about $100 cost for that customer in the long run. But there is variation in this across borrowers. And I think this was what I was asking about. And so there is a distribution. Some customers don't have a low value of kappa, some have a high. And unsurprisingly, those that have the highest cost of individualizing don't get a high deviation. And the customers that have basically no marginal cost of individualizing, then naturally you're going to give them a deviation potentially, if those are going to be the ones you want. So downward sloping curve here. This is kind of nice. I don't want to read into this too much, but what I find is that those customers with high income are the ones with the high marginal cost of individualizing. And this is, I'm really not trying to say that I'm finding some story here about salience and whatnot and understanding, but at least I do find that those with high income have the highest marginal cost of individualizing. And this is like the new part of the paper, and it's kind of moving my paper a little bit more towards this stuff on shrouding, like the behavioral stuff where lenders are trying to kind of confuse or hide things from their customers. And this is at least consistent. I'm not trying to claim I'm showing anything, but consistent with the idea that it's the lower income customers who don't have a high cost of individualizing, which would be perhaps they don't understand it, they don't know they're being individualized and those kind of things. So don't read into my findings too much, but to say that it's at least going that way. Let me finish the talk with the counterfactual exercise. So as we've known now in the data, the lenders don't do much individualizing of interest rates, only 10% of the time. I've estimated as a result, it's kind of not mechanical, but in some respects, it's not surprising. I find there must be some costs of doing so, else they would do it more. So in the counterfactual, as was being said here clearly, it's also about taking away the regulation, the restrictions, but I'm going to also in the counterfactual strip out any costs of individualizing interest rates. And the idea, I guess, is that if you take away the regulation and these costs are like reputational costs, then that's perhaps more reasonable. But this is kind of moving towards the US world where there's no regulation and therefore lenders might, they don't have to advertise an interest rate in America. So customers, when they get their interest rate, they can't be said, well, I thought it was 18 and actually I've got 30, because they don't advertise 18 in the first place. They're very opaque in the US about what interest rate you might get. And I think it's accepted that you can be given a higher interest rate if you're risky, and that's how it works in the US. So I do this counterfactual, I see who does it affect, what happens to lenders, what happens to the distribution of interest rates, credit limits, profits, and surplus. Here's the difference in interest rate distributions. You can just see very quickly discrete distribution in the data, more continuous distribution in the counterfactual. Profits increased by 20%. This is the graph I want to finish on today to get this key intuition that I was mentioning at the start of the talk. So what I do here is I plot on the x-axis the sensitivity parameter. I think this is for borrowing. So how sensitive your borrowing is to the interest rate. So you can think of that as like an elasticity on the x-axis. And on the y-axis is the interest rate that they pick. And I have 4 lines here. So let's start with these 2 horizontal lines. This is the baseline where the regulation is imposed and we have the costs of individualizing interest rates. We know they don't tailor interest rates. So it doesn't matter your elasticity, your sensitivity, whether you're an elastic customer or an inelastic customer, you get the same interest rate. So it's a flat line. And this is true for both high signal and low signal individuals. So remember, the high signal are the ones that have unobservables. So the lender thinks they're a risky person. And the low signal is like the lender has a prediction that they're a safe customer. And you can see these lines are roughly the same. So there's no individualizing of interest rates, and it doesn't depend on your elasticity in the baseline. Now, I do the same in the counterfactual. I'm going to plot these, and you obviously see these 2, the blue and the yellow now, are both downward sloping. So really elastic demand, low interest rate. Inelastic demand, high interest rate. And that's what I've been explaining. So it is the interest rate has a relationship, varies over your elasticity. But what's, I guess, most revealing is that for a given elasticity, so if you fix a value on the x-axis, whether you're a high signal or a low signal customer doesn't change much what interest rate you get. And that's what I mean when I say that there is, for a given elasticity, the lenders don't tailor your interest rate according to their signal on you. And the risk-based pricing is a function of the fact that those that have high sensitivity are safe, and those that have inelastic demand are risky. So there is a correlation between risk and price, but it's not like it's only because there's a correlation between elasticity and risk that we see risk-based pricing. That's the message. Let me skip the implications. I'm happy to talk more about this. I've been speaking about this throughout. Like, what is driving these cappers? This is an open question, not the question I'm answering. I have some chats with people in industry to try and find it out. I don't see how I can address that in the paper, perhaps, but only to discuss it. So let me skip literature and conclude. First half of the paper is this descriptive fact that in the UK and many EU credit markets, lenders are tailoring the credit limit to predictions from default risk and not the interest rate. Then I think, well, okay, so there's a lot of variation in credit limits, so let's write down a model of how lenders set credit limits in credit card markets. That's the endogenous variable of interest with an underlying screening technology that gives them these signals of customers' risk across lenders. The messages are that these advertised interest rates create costs to individualize interest rates, and that the regulation seems to favor the inelastic borrowers. And we do think that there's an idea of risk-based pricing, but it arises because of the link between elasticity and risk. And so we want to think about, when we think about regulating interest rates, there's always this question of, well, what are lenders going to do with credit limits as well that should be considered? Thanks very much for the question and listening.
Thank you. Is there any other question?
I have one. So this cost, this individualized cost, in a more like in an extended model, you would think that it is because of the elasticity, right? And at least this is the intuition that you gave in the beginning, is that I will lose the guy who is more elastic, and the guy who is inelastic, then I would not, and then the cost is lower. And I think that the correlation is is there, right? In your estimations.
Because the high cost for the high income,
right?
And the high income has elastic.
In that.
Yeah. So I mean, that's at least in the reduced form, but I had never thought of whether I can do it more fundamentally.
Okay. But I guess just to understand the policy, maybe is a policy. The policy acts like in the link between the two things, right? I mean, the policy acts over all the clients, but has like put a threshold or something to the guys that are more elastic.
Yeah.
And the inelastic just don't care about it, and you charge more anyways.
Yeah, I hadn't thought about it that way, but yeah. Let me think about whether it might be possible.
No, yeah, it's just to understand the.
If it's possible, I'll try. It would be nice. Yeah. So because it's a bit contrived in some respects. It's not. I don't want to say mechanical, but it's there. So nice. Yes.
You have a question? Yes.
Just a question about the result on screening and risking.
Mhm.
So could this really, I mean, driven by the correlation between your willingness to borrow a lot and to revolve a lot and risk, in the sense that risk is undesirable future for the banks, but actually your desire to revolve a lot in this context in which that's the only way in which you make a profit, really, it's a desirable property. So I don't know, I mean, in the data, it's what it is. They are correlated and that's what you get. But I don't know if you can, like in the counterfactual, see whether this depends on this correlation or would survive, for example, if you break this correlation in a counterfactual. So basically, that they're selecting the ones that will borrow a lot more than the risky ones.
Yeah. Yeah. It seems like I can try that with the counterfactual, but I guess one thing I didn't talk about in this is there's clearly more counterfactuals I can do as well that I haven't done with varying the screening technologies. One thing actually I talk about in the end of the paper is classic thing about mergers, when we think about allowing mergers or not, is the trade-off between increased concentration and cost reduction, right? That's standard horizontal merger story. Here I could potentially measure or think about how the lenders might share screening technologies, and that can measure that side of the cost reduction that could come from mergers. That's another story, but yeah.
Any other question? Right. Thank you, Will.
Thank you. Are you mindful to later? Yeah, okay, great.